Dear viewers, welcome again. Today is our special segment, People Who Matter, where I interview people in the responsible positions, heads of institution, policymaker, influencers and the thought leaders. In today's episode, I am going to interview Mr. Anup Bagchi, Managing Director and CEO of ICICI Prudential, and he is going to talk to you about why it makes immense sense for you to invest through insurance company. Stay till the end of this video. So many points he has shared. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, it gives me immense pleasure to talk to Mr. Anup Bagchi, Managing Director and the CEO of ICICI Prudential Life Insurance Company. ICICI Prudential Life Insurance Company completes 23 years in the service of policyholders, and from tomorrow onwards, they will start their 24th year of service. Mr. Bagchi, before he joined ICICI Prudential as the Managing Director and CEO, has served in ICICI Group in multiple capacities. He discharged his duties as Executive Director of ICICI Bank between 2017 to 2023. He was the CEO of ICICI Securities between 2011 and 2016. He has joined ICICI Group way back in 1992 and served the group for more than 3 decades. He comes with a very rich experience of working in wholesale banking, retail banking, small scale banking, and multiple aspects of banking and finance sector. He has served on several committees of Reserve Bank of India and SEBI. Mr. Anup Bagchi has won several awards during his career. He has won the Outlook Money's Best E-Brokerage House when he was the CEO of ICICI Securities for 7 years in a row. He was also awarded with the Asian Banker Retail Finance Person of the Year Award in Asia Pacific at the Asian Banker Excellence in Retail Financial Services Awards 2021. Mr. Bagchi was also a member of RBI's Expert Committee on Micro, Small and Medium Enterprises and SEBI's Committee on Financial and Regulatory Technologies. He was in the Executive Committee of NSDL, Advisory Committee of BSE Limited. He was also the member of SEBI's Secondary Markets Advisory Committee. So it has been a very enriching conversation with him. Let's see what message he has for the audience of NRI Money Clinic. Dear sir, welcome to this show of People Who Matter, where I interview people who are the heads of institutions, people who are in the position of making decisions, influencers, thought leaders. You as a leader has inspired me a lot. I had a lot of interactions to you on various occasions. It has been my dream to interview you here, and I got this chance today. Welcome to this show on NRI Money Clinic.
And thank you very much for inviting me here. I have interacted with you, has got inspired by all the hard work that you all do and the very, very sharp focus on customers. And, this is something we all live for, that kind of inspiration. And thank you so very much for inviting me.
Sir, before I get started, congratulations to you and the ICICI Prudential Life. You are completing 23 years of service to the policyholders. And tomorrow you start your journey of 24 years. It's time to celebrate. What an occasion for us to talk to you at this point of time.
No, thank you. Thank you very much.
Sir, my first question to you is, Indian public are fond of bank FDs, mutual funds, and the insurance policies. This is primarily where they put their money into, apart from real estate and gold. Between these financial assets in FDs and mutual funds and insurance sector, how is the insurance sector is doing right now? Is there business coming down, business growing? What does the statistics show you what exactly is happening in this industry?
No, I think wonderful question. And I have been privileged and lucky to have participated in all other BFSI sectors, on the mutual fund side, on the broking side, on the investment side, on the banking side, now on the life insurance side. I think the good thing is that each instrument has its own place in the whole financial planning. And the good thing about life insurance is that through its ups and downs, it has always maintained between 16 to 17% of the savings pool of the economy. And that is very, very predictable, because what has happened is 10, 12, 20 years back, it used to be all tax planning oriented, ATC. If you remember, now, of course, it is 88, but it's ATC. And everybody used to say that insurance has to be bought because of ATC. But slowly I have seen and I have witnessed, and very, very sort of happily, that it has started to move towards life events. It has to started to move towards financial planning, orient buying of insurance, and that's a very, very good thing. And if we see the growth is good and growth is healthy, I would say that as of now, it will be mutual fund which is showing the highest growth, and followed by life insurance, and then other instruments from time to time it changes, but on and around 17% of the savings it has always been. And as the savings pool is increasing for the country, I think it bodes very, very well for us, and that is also reflected in the growth of the life insurance AUM. It is reflected in our growth as well. We are now completed, as you said, 23 years, and so it's a great sort of sector. But like all sectors in India, it has tremendous growth potential. Each sector in India has tremendous growth potential. So very, very positive about the sector, and I think it's a very, very important part of the sector. The other big thing that has happened is that customers have started to really look at protection as a big element. 15, 20 years back, it was essentially long-term savings and very less of protection. But now we are seeing that protection is becoming central to the whole financial planning, which bodes so very well for all our customers.
Sir, the finance industry is evolving and has evolved a lot. We have mutual funds, different kinds of funds, ETFs, index funds, AIFs, PMS, fractional real estate. When such an evolution is happening, do you think investing through an insurance company or the insurance products are still relevant in the modern times? Why do you think still it's a must do thing for the saving public?
No, a very, very insightful question you have asked, Dr. Bhatt, and I have gone through your other sort of videos on this on YouTube, and where you have very succinctly put it across. If we really were to see a cash flow statement of any of our customers, which we routinely see, I've seen it in bank, I've seen it in broking, investment banking, I see it in life insurance. Essentially, there will be a bit of EMI, which our customers have to pay, because they would have taken a loan for something, for home loan, for personal loan, for whatever. Then there is always a large consumption item that is there for day to day, and then there are other sort of family obligation related payments. It could be education, it could be rental, it could be those kind of thing. And then you have a little bit of surplus. Now when you have little bit of surplus, what you do is, rightly so, you should invest. One must invest in liquid instruments, because you never know when liquidity is required. But as you move in time, some part of the surplus you must build towards other corpuses, because while this is at a point of time, is what I discussed, EMI and consumption and a life goal oriented and surplus, we still have to manage the long term goals. So long term education, long term marriage, retirement is very, very big, because societal shifts are happening. And so some part of the surpluses must be kept aside for long term compounding there. And so customers must not get confused by all the products that are coming out in the market. And I've been in this industry and dealing with customers for very, 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 very long. And I must admit, as you're saying also, that many customers get very confused with so many different options that are there. But I always advise our customers that, for 1 hour or 2 hour every week, one should sit as a family and one should discuss financial planning. We seem to be discussing, more on which movie to see rather than long-term life goals. So I would really, really request, through a channel, that each of our families, each of our customers must sit together and really jot down how much is going to EMI, how much is going for, education fees, rentals, etc. How much is going for consumption, which they can cut, and then they can increase the savings pool. How much is short term and how much long term they can do. And for the EMI and for income, they must first, before they generate a corpus, they must take protection. they must take protection, because the other big societal trend is that many people are dependent on you. Your children are dependent on you. Your spouse is dependent on you. And in many cases, we see the parents also are dependent on you. So first is to take protection. Second is to take health insurance. Very, very important. Health insurance, particularly critical illness, because it is critical illness which really drains a family of savings corpus. And then, of course, one should take normal health insurance also for day to day OPD and hospitalization and other things. And then one must start to invest, and invest for long term, and invest. And there are three things to invest. How much are you investing? What is the kind of return that you will get on that investment? And what is the tenure of investments? And all these three have positively outsized impact. So one must try to invest as much as possible. One must try to increase return, but not abnormal return, because if you get into speculative things, what happens is that you may end losing capital, which is not a good thing. And third is time horizon. So two things are certainly in our hands. Time horizon is in our hands. The corpus that we are investing is in our hands, and one can cut by way of EMI if it is of not of useful variety, or cut consumptions to increase the amount. Two things which are in our hands. So I think we should take control of our lives. We should protect our loved ones. We should protect the assets, particularly because if you are running a home loan, we have seen home loans, we have seen transporters, that's the only earning asset that they have. And if something happens to the asset, it is heart rending. The kind of things, of course, emotional trauma one cannot take out, but financially one should be able to protect. So insurance in that perspective has a very distinct place in the overall thing. It is not just, so protection is a very distinct thing. It has no substitution. Retirement planning, there is no substitution. There is no product which helps you retire and gives you reinvestment risk, because insurance gives guaranteed returns. No other instrument gives guaranteed return. Part of the surplus that you can have over growth, part of it you can put in other instruments. Part of it, of course, you can put in life insurance, and their tax becomes a very important thing, because while insurance is illiquid and it is not that liquid, one gets a tax benefit. And over long tenors, every percentage that you save on tax is really adds up to a very, very large corpus. But I must say that both coexist. Mutual fund, FDs, life insurance, they coexist. I will never say that everything you should put in life insurance, but you should not put everything in FDs also, because there is too much of tax and you don't generate wealth. Wealth comes from growth. So sorry for a long answer to a very, very important question, though, Dr. Bhatt.
See, I'm in a practicing line. I keep interacting with the general public. One observation I made, when an advisor talks to a person, he will resent buying a policy. I've asked people who have come to me, have you at any point of time repented for having bought the policy? The categorical answer I get is no, we have never repented for having bought a policy. That speaks volumes. Yes. See, you have to push people to save. You should also push people to stay invested for longer periods of time. Yes. Probably the policies serve this purpose very well. If somebody is not pushed to save, probably he will spend it. So what they save in the form of insurance policies many times have to be seen not as 6%, 7%, 8%. You add 100% to it, because if there is no policy, you will not even save that money. Yes. So that's it. Gone. So in that sense, probably the insurance policies will give the highest amount of return. That's the way I will look at it from a behavioral aspect of general public.
No, absolutely, Dr. Bhatt. Actually, I have seen the data, and what happens when you get into liquid instruments, let's say mutual funds or FD, where there is a lot of liquidity available. Now, what happens is behaviorally and discipline wise, one tends to redeem, one tends to time the market, one tends to do many things, and the loss of return is very high for the investors. In fact, when large funds have very large number of policies, actually the number of persistent policies folios are very, very low. Because there is always this liquidity available. In insurance, there is no liquidity available, and it disciplines you and forces you to stay put for a long period of time. But I must add that if the horizon is short term, mutual funds and other instruments are the way to go. But for corpus building, There is no better thing like life insurance. But if it is a short-term investment, life insurance is an expensive instrument, and it doesn't have liquidity. But there is no better instrument, tax adjusted as well as expense adjusted, if you are there for the long term, and for corpus building, for different thing, for marriage, for education, because education is happening after 17, 18, 20 years, the moment a child is born, or for your own retirement, which will happen after 25 years. There is just no better instrument. And insurance also takes care of your reinvestment risk, because if you look at interest rates, it has gone up, gone down, gone up, gone down. And we have seen, for example, my father, when he retired, FD rates was at 12%, and he retired and put money in FD. And then when it came for maturity, the interest rates had already come down to 8%. His heart was broken, because there was no reinvestment risk, and it kept coming down to almost 4.5, 5%, 5.25 became the FD rate. Then it popped up a little bit to 6.5, 7. But if you see, the volatility of interest rates are very, very high. Personally, I have invested in treasury, 10-year government security at 14%. And I've also invested in 5 quarter. I've also invested in 7%. So people, sort of customers, don't have a long-term view, perhaps, of the volatility on the interest rates. So I would say wherever interest rate reinvestment risk is taken care of, that is why world over there is so much demand for defined benefit as against defined contribution for pension. So I would say that some of the products, they don't have any substitute for that. Yes, but if you have little surplus, one should not get into illiquid instruments. You should put only that much, so that your persistency is high. One must have high persistency for good experience in this product.
Thank you for highlighting this point. Even during my conversation with our clients, we tell them about the reinvestment risk. People do not understand what it is.
Yeah.
Where I give them an analogy, we are working today. Imagine a situation after 5 years, your boss comes and says, I will give you 10% less, 20% less, 50% less. Do you like that situation?
Yeah.
You do not like that situation during your retirement days. This is exactly what is going to happen. So it is very, very essential for people to be cognizant of this imminent risk of reinvestment risk and take meaningful steps today to see that they have a predictable cash flows. Probably I have no doubt in my mind that the insurance companies are well positioned to cater to the need of the general public.
Yes.
Yeah. Having said that, the testing times for the insurance companies are when a claim arises.
Yes.
We saw the pandemic few years before. It's still in the green. It's a shock for the general public because of the bereavement which happened. It's a shock for the insurance companies because they have to pay out a huge chunk of, claims settlement. What has been your experience of working through this pandemic? How did you manage? How did it hit you? And how did you raise to the occasion to pay the claims? Can you quote some statistics if you have?
No, very, very relevant point, Dr. Bhatt, because if you look at ICICI, Prudential, and our character, ICICI Group started in 1955. And, it was promoted by quasi-government, World Bank, because World Bank had put a condition that, you cannot sort of invest directly. And so for a large proportion, and even now, our largest shareholders are LIC, and general insurance companies were our largest shareholders for a long period of time. After that, of course, we got listed and other shareholders came in. So the character of our institution is a good blend of a public sector and a private sector. Public spirited, I would say, and private sector agility, and private sector innovation, and private sector thought. And during the pandemic, I must say that ICICI Bank, our parent, they were very, very clear that every claim has to be paid, and if capital has to be infused, so be it. But fortunately, our solvency ratios are very good. Our capital situation is very good. We never needed it. That's a separate matter. But I must put on record that ICICI Bank was very, very upfront and very forthright that every claim must be paid, because the moment of truth is at the claims. And if you look at ICICI Prudential, we are right up there. We are always number one or number two in claim payment. In the H1 this year, we are at 98.4% claims. we really see three things are very important for our clients. One is claims, because at that point of time, it is so critical, because emotional trauma you cannot handle, but financial trauma we must try to reduce as much as possible. Number one. Number two, persistency. Why persistency should be high is because in our business, except in ULIP where you get the full principal and some return also back, in many other traditional instruments, you may lose, the cost of liquidity is high. And so persistency should be good. And persistency is a function of the income estimation, that what proportion of income are you putting in life insurance. If somebody oversells or somebody overbuys, the chances are that they may not be able to persist the policy for a long period of time. And just the way you don't default on EMI payments, similar should be the thinking as far as premium payments are concerned, that one should not default on that, because a lot of benefits get taken care of. And third is because there is a large, long savings and investment, long term. We hedge it completely so that the reinvestment risk is taken care of. And we try and give long term returns with low volatility. And which is why we ourselves say that if you want to play momentum, insurance is not the right way to play momentum. For playing momentum, take a corpus, small corpus out. You want to do FNO, you take 5% of your corpus and you play FNO. You want to sort of do intraday trading, you take a very small corpus, you want to do, if you do. But for your long-term need, long-term requirements, long-term corpus building, that is unlikely to give you long-term corpus building. Long-term corpus building is disciplined, long-term, sometimes very boring, but that is what compounding, which is why Einstein said that compounding is the eighth wonder of the world. And it is true, when you compound over a long period of time, it is astounding the amount of corpus that gets created. We are 23-year-old, and now many of our old esteemed policyholders, they get a lot of corpus back, and they are surprised by the corpus that they get back, because simple investments of 10,000 and 15,000 per month now is giving them corpus of 1 crore, 1.5 crore, 2 crore. They can't believe that a monthly savings of 10,000 crores can ever give them a corpus, and that too tax free, of 2.5 crores. But the best thing I have seen about discipline in financial is that you have to get an inertia to work for you and not against you. And for you means when Dr. Bhatt comes and tells you, buy a policy, keep money aside and buy a policy, and then forget it. Keep paying the premium, and you will see fantastic. Your premium paying terms will be 10 years, and then it compounds over 20 years, and your retirement is taken care of, or your marriage corpus is taken care of, or your education is taken care of. That is really the way to really think about financial planning.
Sir, insurance company, the business is dominated by the state player. People want government to take care of it. There is a perceived notion in the minds of public in doing business with a private life insurance is riskier. Now we have completed 23 years. During the course of time, you have grown, become prosperous. You have given an exit to one of the company which was in distress. How do you counteract this view that private insurers are not safe and the government insurance company is the safest one? What message you have for my audience?
So I think a point that you made is an absolutely important point. From ICICI, I can just say that ICICI Group is a child of post-independence, 1955. So we really are very old and public-spirited company. We don't have an owner as such, and so we don't have a private owner. It is owned by institutions, and as the age increases, I have seen, now we are 23-year-old. As the age increases, I think the delta in the mind of the customers, because they have seen us being around for a long period of time. They have seen us paying claims for a long period of time. Because really, I mean, if somebody is buying a policy for 35 years, I think it is right for the policyholder to also think that, is the institution taking mortality risk on me, or am I also taking the mortality risk on the institution? Because the institution must survive when the time of claim comes. And so life insurance globally is always, finally it boils down to 5-6 players only. Over a period of time, and you have to demonstrate trust. You have to demonstrate trust through conduct. You have to demonstrate trust through claims, and not just demonstrate trust through aggressive selling. because we really believe in ICICI Prudential. We really believe that our main job is not to just take the premium when it comes. It is really to pay claims when it comes, and which is why our claim settlement days is 1.2 days. So it is 1.2 days and around 99%, because we really focus on that. And we keep solvency for that, we keep liquidity for that. We do not keep open positions, unhedged positions on reinvestment risk for that. And I must say that both our parents, shareholders, ICICI as well as Prudential, they are extremely focused on that. Prudential itself is 175-year-old company. They really understand that it's a long game, and customers don't have exit. Customers also, our policyholders, don't have exit. So we have to be that much responsible and really act like a trustee and custodianship of our policyholders' money. Because in protection, if you see, for 1 rupee of protection, 1 rupee that premium, you get 400 rupees of protection. It's a very large sum assured that we play with. 30 lakh crore is the sum assured that we play. It's larger. Actually, ICICI Prudential sum assured is larger than the largest public sector player that we have, who have done such a big service to the nation since so many years. But the responsibility that insurance companies, particularly life insurance companies, have because of the long-term nature is really something that all of us have to live and feel and act and behave like a trustee and a custodian of policyholders' money. That's the culture of ICICI Prudential, and you have been associated with us and you have seen us, as a third party from outside, and that is something we will really live by, and that will bring trust of policyholders.
So there is a dogma on the internet: do not combine insurance and investment
Right.
together. In spite of that, what explains the popularity of insurance policies? My first question was on what's the share of insurance companies in the public saving. So there is so much of a campaigning against the companies, but the products are still popular and they are latched onto. What explains this popularity?
Yeah, no, I think you're right when you say that there is a feeling that term plus mutual fund is greater than equal to ULIP. But when we look at numbers, so first is from a tax perspective, tax adjusted ULIP is much better than mutual funds plus term. In debt, there is no other place where you get any tax benefit except in ULIP. Third is on the switching. There is no switch cost. While every time you sell and you switch in mutual fund, you have to pay tax. And my customer behavior, when people switch, they actually sell and wait for some time. They don't switch, and so there is a loss of return when you switch and keep it in savings account for a long period of time. But anyway, switching cost is zero, which is a very big benefit, because you may want to move from small cap, mid cap to large cap, or from large cap as you age, you would want to move to debt. The switching cost without tax is a very important thing, because every time you pay a tax, your reinvestment amount reduces and your overall amount reduces. So switching cost is important, tax benefit is important, and on top of it, after 5 years, it becomes completely sort of tax free, and so people put it in ULIP. And if you are there for a longer period of time, 7-8 years, even in absolute amount, cost, because our FMC is 1.35%. So in insurance, so it's lower than in mutual fund. Over a period of time, actually, it turns out to be much more cost effective. But you have to be there for a longer period of time. It turns out to be most cost effective than mutual fund and term. The sad part also, I must add, is that while this discussion is around, people still don't buy protection as much. So I would still be happier if people buy protection and they buy mutual fund separately. I will still be happier. But people must buy protection for EMI, and they must buy protection for their income substitution, income protection, and they must buy it for long-term corpus building as such, because the families are becoming nuclear. There is much more responsibility. So in that, whatever is the discussion, I will still request everybody, at least buy protection first. Protect yourself. Then you can keep discussing whether protection plus mutual fund is better or ULIP is better, but at least buy protection.
Sir, our audience has been primarily the NRI community. Our channel is viewed across globe. We have quite a huge fan following across globe. We transact with a lot of clients across globe.
Yes, yes.
One of the hesitation of NRIs to invest in India is I'm worried about how will the rupee depreciate. I put money, I have an option to put this in dollars. Now I bring it into the rupee. The question they have in their mind is by investing in India, will they make real money in dollar terms? At least in your case, you have funds which are running from 2000. You have the maximizer fund,
Yes, yes,
which has been running a stellar performance over 2 decades. Not something to be brushed aside as something is a beneficiary of a spike in the market. It has withstood
yes.
several bulls and bear markets. What has been the experience? What message you have for the NRI community? Can they boldly invest in India?
No, so I think it is a question that comes to us quite often. It comes to us, in the bank. It comes to us, to me personally, because from the background, because I come from IIT, so not half of my batchmates are overseas. They keep asking me in WhatsApp groups, what is my view? See, my view is, and it is also backed by data, that if you want to take a short-term view, one must not take short-term view either of the currency or of the index, because you never know in 3 years where will it be. Because if you see the depreciation of rupee, there is constancy, and then there is a slip, and then it again steadies, and then there is again a slip, and then it again steadies. That is generally the method. But over a period of time, I've also seen in the last 8-9 years, generally the tendency is not to slip too much. And if you see maximizer return, as you said, and if I decrease and lessen the depreciation over a period of time, it is a very, very healthy return. Because for a long period of time, US, etc., they were at almost 0% return. And it is only now that the returns have sort of gone up. And so when you invest for a long period of time, when you invest for a long period of time, it is only then you get the benefit of volatility on your side, both of currency depreciation as well as the index. And if you are short term, then it is, I would say, in some ways, it is speculation, because you never know. You can get into a bracket where it is just becoming very volatile. So if you run the numbers also, it is quite beneficial to invest in India. And India is becoming a strong country. And whenever there is a strong country, there's always a bias, a positive bias on the currency. So all in all, I think one should not worry if one is there for a long period of time.
Thank you for these inputs for the benefit of the NRI community. And for the sake of lightening the moment, I have designed a rapid fire round for you.
Sure, sure.
It will be an unannounced quiz. We'll not be holding you responsible for whatever answer you give. It's a fun round. You can think that it is a CEO poll. It's as simple as that. Let anything happen. Future is unknown. Future is unpredictable. Anything can happen. I just wanted to check from you. What do you feel about this? Shall I start asking you?
Sure. Always, always.
We have the elections around the corner. What message you have for the audience? Invest now, invest after elections, invest systematically. One word answer.
Invest systematically.
5 years from now, Sensex will be above 1 lakh, below 1 lakh. We'll skip this question.
I'll skip this question, but chances are it could be more than 1 lakh, because it is almost 70,000 now. So 70,000 to 1 lakh is not very far off. Say 30-40% over the next 5 years. So it's doable.
5 years from now, INR versus dollar will be below 90, above 90. It is futile to guess.
Futile to guess, but most likely below 90. Futile to guess, though, I must say, but most likely below 90, because as the country strengthens, I've seen other countries that the currency sort of stabilizes much more.
Equity investments. Invest 100%. Don't invest at all. Maintain exposure control.
No, maintain exposure control. Always maintain exposure control.
By 2030, Indian economy size will be below 7 trillion USD, above 7 trillion USD.
Most likely above 7 trillion. Just about 7 trillion.
If you were to be an investor, which one will you choose out of these? A pure equity fund, a balanced fund, a pure debt fund?
A balanced fund, because my requirements are very different. See, requirements which are growth oriented and very long term, there I'll go for equity funds. Where it is more non-negotiable, for example, education, As the time comes nearer, I will shift towards debt, and which is very actually the point that you asked Dr. Bhatt earlier is important, because when the switching cost is zero, you can easily shift. As the when the horizon is very long, you can get into equity, and as you move nearer towards the goal, you keep switching systematically into debt. So I would say both.
By 2030, inflation in India will be below 5%, above 5%, too difficult to guess.
Most likely below 5%. See, if we have believed that Indian economy is going to strengthen, then inflation will be lower, interest rate will be lower, currency will be stable.
By 2030, long-term FD rates in India will be below 4%, above 4%, can't guess at all.
It will not go towards 4%, but it will tend to trend lower than what it is now.
So thank you very much for your time and all these answers. And it has been words of wisdom. You are a person who has spent more than 30 long years in the finance industry. You have the experience of working in banking, retail, regulatory services. You have been awarded with multiple awards during your career. It has been a great, great pleasure, immense satisfaction for us to do this interview for you. I will keep calling you for more interviews as time passes by. We remain in gratitude to you on behalf of NRI Money Clinic and on behalf of our audience for your time and kindness to come and share your thoughts here. Thank you very much, sir.
No, thank you, Dr. Bhatt, for having me here. And nothing gives me, greater joy being a retail person at heart. Although I've done corporate banking and treasury, but nothing gives me greater joy than just seeing through finance people meeting their dreams and people meeting their objectives, because it is there where market works for you. You don't have to work. You have to just be disciplined, and you have to be little bit wise, and work with advisors with you, and then market works hard for you. And what a joy it is when we see so many of our clients doing so well and creating corpus, and having great retirement, great education for their kids, great meeting of their own financial needs. I think it is so wonderful. That's the most satisfying and fulfilling part of the job. We are blessed. Thank you.
Thank you, sir. Thank you.
Dear viewers, hope the conversation I had with Mr. Anup Bagchi was enriching and gave a lot of insights into why it makes sense for you to invest through the product offerings of insurance company. If this gave you a lots of insight, do not forget to give me a thumbs up. If you are a person who is watching my channel for the first time, please do hit the subscribe button and press the bell icon. Do not forget to share these videos with your friends and relatives, near and dear ones, and on all the social media on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another episode next Tuesday. Till then, stay safe. Jai Hind, Jai Bharat.
Press the bell icon for more details and subscribe our channel.